Ever wondered how a fixed indexed annuity works and why it's becoming increasingly popular in the financial world? Well, a fixed indexed annuity is essentially a contract between you and an insurance company. What's unique about this contract is that it offers a blend of both protection and potential growth. It protects your principal from market downturns, ensuring that no matter what happens in the economy, your initial investment is safe. Now, this is where it gets really interesting. Unlike other types of annuities, a fixed indexed annuity comes with a unique feature called indexing. This feature allows the potential for growth based on the performance of a market index. This means that while your principal is protected from losses, it can also grow if the market performs well. So a fixed indexed annuity is a blend of protection and potential growth. But how does this growth happen? It's all about indexing. Let's delve into this. The term indexing may sound complex, but it's really not. It's a mechanism that links your annuity's growth to a market index. Now let's break this down a bit. When we talk about indexing in the realm of a fixed indexed annuity, we're not talking about direct investment in the stock market. No, this is a slightly different ballgame. Instead, the growth of your annuity is credited based on a formula that's linked to a market index. And what's a market index, you ask? Well, think of it as a group of stocks that represent a market or a part of a market. It's like a snapshot of the market's performance. Now, let's come back to how this ties into your fixed indexed annuity. Imagine your annuity as a tree. The fixed part of your annuity, your principal, is the trunk of the tree, solid and steady. It's not going anywhere, regardless of how the winds of the market may blow. The indexed part, on the other hand, is like the branches of the tree reaching out for sunlight. It's here that you have the potential for growth. When the market, or in our analogy, the sunlight, is strong, your branches can grow, adding to the overall size of your tree. Your annuity can credit growth based on the performance of the market index it's linked to. But what happens when the market takes a downturn? Or in our tree analogy, what happens when there's less sunlight or even a storm? This is where the fixed part of your annuity comes into play. Your principal, the trunk of the tree, is protected. The branches may not grow during this time, but they're not going to wither away either. You won't lose your principal due to market downturns. So the concept of indexing allows for potential growth during market upturns, while the fixed annuity part acts as a safety net, protecting your principal during downturns. So in simple terms, indexing is a way to potentially grow your money with a fixed indexed annuity while having a safety net during market downturns. A pretty neat concept, isn't it? Now that you understand how a fixed indexed annuity and indexing work, it's important to remember a few key points. Let's start by summarizing the main aspects of a fixed indexed annuity. It's an investment contract between you and an insurance company. You provide a lump sum payment or series of payments, and in return, the insurer promises to make periodic payments to you, either immediately or at a specified date in the future. One of the most significant benefits of a fixed indexed annuity is the safety of your principal. That's right, your original investment is protected, regardless of how the market performs. This safety allows you to sleep well at night, knowing your money is secure. Next, we have the potential for growth. Unlike traditional fixed annuities, which offer a guaranteed interest rate, fixed indexed annuities offer the opportunity for higher returns based on the performance of a market index. However, it's important to note that your growth is capped. In other words, there's a limit to how much you can earn in a given year. The tax-deferred status is another key point. With a fixed indexed annuity, you don't pay taxes on your earnings until you begin to withdraw your money. This allows your investment to grow faster because it's compounding on a larger base amount. Another point worth noting is the possibility for lifetime income. A fixed indexed annuity can provide a steady stream of income for as long as you live. This feature can be a valuable tool for retirement planning, giving you peace of mind that you won't outlive your savings. However, like any investment, fixed indexed annuities come with potential downsides. There might be fees and surrender charges involved, and it's not a short-term investment. It's a long-term commitment that requires careful consideration and planning. So, a fixed indexed annuity can be a powerful financial tool, providing a unique blend of safety, growth, and income potential. But remember, it's essential to understand how it works and whether it aligns with your financial goals before making a decision.